Well, good afternoon and welcome to HIROC's weekly webinar where we are going to talk about what we see happening in the global economy, in financial markets and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, happy to be back in the driver's seat, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HIROC, who, by the way, has done some great bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year, continuing to add value to our portfolios while at the same time reducing our exposure to risk. Our financial planner and wealth forecast specialist, Bianca Tomlinson, is also on the call. And we're going to have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we do have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, as we do for each webinar, let's quickly recap our themes for 2016 before we get started on what happened since we last talked. As you all well know by now, our overriding theme for 2016 is that financial markets will remain volatile. January and early February saw a spike in volatility. The market settled thanks to continued central bank monetary stimulus. Volatility bounced back in the uncertainty that was post-Brexit, and although it has calmed again, uncertainty has far from gone away. The U.S. economy represents 20% of the global economy, and over 50% of the companies in our benchmark equity index are domiciled in the U.S. So we spend a good deal of our efforts trying to determine how the U.S. economy will evolve. The U.S. economy barely scraped by in the first half of 2016 with an annualized growth rate of about 1%. Things are looking a little better at the moment for the third quarter, but that is how the second quarter started before it fizzled. Low inflation and deflationary pressures continue on a global scale despite the efforts of central banks. And more stimulative central bank monetary policy on its own has not succeeded in reigniting economic growth just yet. Geopolitical uncertainty has become a major factor. Brexit and the rise of populism in developed nations, the United States presidential race, terrorism, and instability in some countries are all having an impact on the consumer, business, and investor psychology. There has been a flight of capital into safe government bonds, driving prices higher and yields to record lows, negative returns, and flatter yield curves, which foretell of potentially more economic pain. Equity markets prices have been comforted by central bank monetary policy stimulus to combat the potential for additional volatility. Now, current levels, they are as expensive in terms of earnings and valuations as they have been, and our comfort level with this asset class continues to remain very low. With no clear economic direction, businesses will tend to postpone investment decisions, and consumers will postpone spending decisions until they can get a better sense of what to expect in the future. And we're going to focus on that in today's webinar. We are in a time when the risk-free rate of return is close to 0%, which means that to get the higher returns that they want, investors are taking on more risk, likely more than what we would consider to be wise. We think that this makes for a dangerous situation for investing and that caution should be the order of the day. Okay, let's look at what's been driving markets since we last talked. After spikes in January and February, again in June, as I said, volatility hit its lowest levels in August. There is still 4 months left in the year, and September, October is traditionally the most volatile time of the year. Historically, when it gets to these low levels, the next move is upwards in volatility. So we'll be watching for that. Fear and greed index moved up to nosebleed territory into the 90s before slipping back to its current level in the mid-60s. Well, cause and effect. When markets get overbought, the next move is usually lower, and so far this is what we're seeing. So we can expect some potential for markets to move lower over the next little while. Since our last webinar, our benchmark World Equity Index is lower by about 0.25% and better by about 5.25% on the year. China's Shanghai Composite Index was the best performer, and Australia's All Ordinaries Index was the worst performer. The Canadian TSX has been the best performing country index in the developed world this year. China's Shanghai Composite Index has been the worst performing index. Well, the broad and diversified benchmark equity index upon which we gauge the performance of our model and portfolio performances cover close to 2,500 companies domiciled in 23 developed countries and 23 developing countries. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. And over the last 3 weeks, there has been little follow-through buying after our benchmark All-Country World Index broke above its downtrend channel, which began back in May of 2015. Trading volume has remained quite light, and to date, in 2016, the ACWI has posted a return of 6.7%. The one-year return has jumped to 7.4%, 7.3% for 3 years, and 85% for 5 years. And if you combine the equity and bond indices into a balanced scenario and allow for fees and MER costs, the total return for a 60% equity, 40% bond index combination year to date is a little over 5%. The one-year return, about 5.30. 3-year return, about 5.5, and the 5-year return, about 5.80. A less risk-oriented 40% equity, 60% fixed income portfolio year to date after fees and MER about 4.75. The 1 year about 4.89. 3-year about 5.20, and the 5-year about 4.88. Now, by comparison, the client who started with it in January of this year has a total return year-to-date after fees and costs of about 6.25%, nicely ahead of the benchmark, which comes in after fees and costs at about 5, a little over 5%. Well, the Canadian Preferred Share Index has dropped about 2% since we last talked. As we had been suggesting, there is new supply being added to the Canadian Fixed Reset Preferred Share market. TD issued $1 billion in fixed rate reset preferred shares yesterday. Canadian high yield, on the other hand, has moved higher. On the year, Canadian high yield has considerably outperformed Canadian preferred shares. So if you're selling Canadian high yield last year, it was probably not the best in timing. Oil continued to move up over the last few weeks, but copper, something that we monitor as a global indicator for the strength of the global economy, was lower. Well, oil, after breaking its uptrend channel, bounced off of the $40 level a few weeks ago. Paul's going to talk about this a little later. He's been active in the tactical portfolio with energy names. The Bloomberg Commodity Index has been struggling to remain in its uptrend channel, and we're watching to see how this moves over time. With over 50% of the companies in our benchmark domiciled in the U.S., we keep a close eye on what is happening in the U.S. economy. With almost 70% of the U.S. economy dependent upon the consumer, it is important for the consumer to be confident. When consumers are uncertain, they will postpone spending. When businesses are uncertain, they will postpone investing. This makes it a tough environment for economic growth, which in turn makes it difficult for corporate earnings to grow. Well, the latest presidential election polls still give the edge to Hillary Clinton, but there is still plenty of time between now and November for things to heat up. This is an enormous amount of uncertainty, as it could considerably shift the balance in the world political situation and certainly the North American situation. The U.S. businesses are more confident but are not investing at the moment, and the consumer is more skeptical. Although, interestingly, it is the consumer spending that is driving third quarter growth expectations for a 3.5% GDP growth rate. And this week we'll be watching Friday's U.S. unemployment data release with lots of interest. As we have mentioned here on numerous occasions, historically, when the 3-year moving average unemployment rate converges with the actual employment rate, a recession has followed. The 3-year moving average is declining at a rate of 0.1 to 0.2% per month, so it is only 4 or 5 months until it moves from its current level of 5.8 to about 5%. Now in July, the unemployment data in the U.S. remained unchanged at 4.9%. If the U.S. unemployment rate remains the same or moves a little higher while the 3-year moving average continues to fall, a recession will likely follow shortly thereafter. And certainly this will be something that worries us. And elsewhere in the global economy, Brexit and the potential political and economic fallout are on our radar screen. Unfortunately, it may take some time yet to determine what exactly will be the end result, but until then, there will certainly be plenty of speculation and uncertainty. 1 month ago, the Bank of England launched a huge new stimulus package in order to mitigate the damage the Brexit vote would have on the UK economy. The package included a 25 basis point cut in the bank rate to 0.25%. Since then, the pound has stabilized at levels about 11% lower than where it was pre-Brexit. The early post-Brexit data showed significant deterioration in both business and consumer confidence in the UK. However, it is expected that the Bank of England's policy stance has had a stabilizing effect. As I said earlier, the impact will take many years to sort out, and we will continue to follow developments on this front very closely. Meanwhile, the other impacted economies in the euro area show that the latest readings on euro area business and consumer confidence are showing signs of decline. In Japan, business confidence has been slowing, while the consumer seems to be somewhat more hopeful. And here in Canada, Canadian business and consumers appear to be rather optimistic. Perhaps this has some link to the new Liberal government and their fiscal policies, and certainly the current U.S. election polls. However, it is an interesting contrast to the confidence or lack thereof in the U.S. consumer. And in China, business optimism is slowly declining, but the consumer is, at the moment, rather excited. So where do we see all of this taking us? Well, bond markets lead other financial markets, so let's see what bond markets are suggesting. In the U.S., higher short-term rates on increased expectations of a Fed increase in September and lower long-term yields have flattened the yield curve over the last 3 weeks. A flattening yield curve historically signals a coming recession. If the Fed does raise rates, that will take us one step closer. In the UK, the yield curve is flattening as well, increasing the chances of recession there. In Germany, yields are below zero out to about 15 years. The European Central Bank is artificially keeping the yield curve from flattening with their monetary policy and negative interest rates. There's not much change in this curve from 3 weeks ago. Japanese yield curve steepened further this past few weeks. A little more economic confidence. Sorry, that's not correct because that's an old slide, so I'm going to retrace that and say, like the European experiment, the Bank of Japan is also using negative rates to keep the yield curve from flattening with limited success so far, and we see a little flatter curve since we last spoke with long-term yields falling. So yield curves flattening globally, not sending promising signals for the global economy. In Canada, Canadian business and consumers may be more confident, but the flattening yield curve is telling us something different. We need to heed the early warning signals from the bond market. Well, as for equity market value, second quarter earnings are all but finished after 93% of the S&P 500 companies have reported. There has been an above average 71% of upside surprises versus the 5-year average of 67%. Year-over-year earnings growth declined by 3.2% in the second quarter, better than the June 30 expected growth rate of a negative 5.5%. Why are earnings important? Well, when investors buy stocks, they buy a stream of future earnings which go to pay dividends or are reinvested in the company. Now, the price to earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price to earnings ratio is 14.5 times, actually 14.5, not 14.3. The 12-month moving average, 12-month forward price to earnings ratio is currently at an approximate 17 times, and that difference makes stocks quite expensive. This year alone, earnings for the year have been revised from an expected rate of growth of 6% at the beginning of the year to a negative 0.4% at this particular time. While S&P 500 stock prices have risen by about 7%. Third quarter earnings are expected to continue the negative growth for a sixth consecutive quarter. Why are stock prices so high? Well, because investors are taking on greater risk as they chase higher potential returns, opting for better yields from dividends than from safer assets. However, even a little increase in volatility could erase any extra returns that they may be getting from dividends. So we prefer to be significantly more prudent. What does it all mean? Well, so once again, we repeat our mantra. For well over 1 year now, we have taken a cautious and defensive posture to investing, and it has been fortuitous for our clients and for ourselves. Remember that we are investing in the exact same models and securities that you do. We monitor a great many metrics that help us to determine where there might be some value, but until we are convinced that there is value, we will remain patient. With increased levels of uncertainty arising from the Brexit referendum, we are in no hurry to take added risk unless we see reasonable opportunity. Others may not be willing to take on, others may be willing to take on greater risk. We are not. And cash and cash equivalents have been and continue to be important defensive assets, so we are carrying greater than normal cash balances in our models. If we can attain better than benchmark returns, having more cash and less exposure to risk, we are taking smarter risk. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, goals, risk tolerance, and time horizons. However, the ongoing research and analysis that we do at High Rock will dictate the minor adjustments in short-term strategies that we make in our models, which we believe add value to the long-term performance. So to answer the common question, if you are so cautious, aren't you missing out on the rally as equity markets hit new highs? Well, the answer in a nutshell is no, we're not missing out. We are taking less risk and still getting better than benchmark returns, which means significantly better risk-adjusted returns than those who are fully invested and are exposed to greater amounts of risk. That is how we add value. If, as we suspect, stock markets correct, our models and portfolios will give back less and keep more than the higher risk buy and hold strategy. So what is new with our tactical model? Paul?
Thanks, Scott. Just a couple comments. We had a fairly decent call. We added some energy names when oil got down to just under $39 back in late July, about a month ago, and we rode some of that up. So we had a little bit of positive performance from those positions. And then last week we did sell out of partial positions on a couple energy names in the tactical model. In fact, just this morning we bought one back. waiting on another one. So we're just trying to be patient and take out small gains where we can. The market is obviously pretty choppy, certainly in the energy space. And I'll just make one more comment to yours, Scott, on maybe the previous slide, but not only are we having some decent calls in the tactical model and helping our performance overall, but you should also probably let some of our investors and listeners know that we're pretty well fully invested in our fixed income model, and not only are we fully invested, we've had some really good calls in there on different parts of the yield curve and different securities within that fixed income model. So that's also where we've received pretty good performance year to date on some of those really good calls in there. That's it for me.
Terrific. Thank you very much, and thanks for the update. And it's great, and you know, keep up the good work, because it certainly is adding lots of value, and especially when we're not getting what we would consider to be great performance from our global equity model. We're certainly making up for it in our other models, and that's the great thing about being able to reduce our risk at a time when we think risk should be reduced and not increased. All right, well, that's it for today's discussion. If there are any questions, this would be a great time to bring them forward. All right, no questions today. Questions may still be on their summer break. So if any of you listening to the recorded version might have questions, please feel free to email them to us. We also appreciate all the feedback that we get on these calls. And as always, thank you for taking the time out of your busy schedule to tune in. Don't forget to tune back next Tuesday, September the 6th. But until then, this is Scott Tomlinson signing off.